I'm going to introduce Ranji Nagaswami to you. Ranji is a senior advisor at Corsair Capital and an MBA from Yale School of Management. She and I were in the same class at Yale, and we got to know each other at that time. I think maybe even then shared an interest in finance, but our careers went in somewhat different directions, mine in an academic direction and hers in a professional direction. And we found ourselves later in our careers with a mutual interest in asset management, portfolio management, and particularly portfolios that are related to some kind of mission or benefit to society. We find ourselves working together from time to time on really interesting portfolio problems. She's got a classic Yale School of Management trajectory to her career. And just to give you an example, some of her most recent work, she was at Bridgewater for some time, but before that she was the chief investment advisor to the New York City pension funds under, she was invited by Michael Bloomberg to come and work on one of the thorniest problems in the world of investments. And she made great progress in what I would say call rationalizing the approach of New York City to their pensions. Before that, she was a CIO at AllianceBernstein Investments. Lately, Ranji has gotten very interested in the thinking about how to push this kind of agenda of larger perspective of finance and society, and how much can be done through education, and how much, just exactly how to think about getting leaders in the world of finance to think about the purpose of what they're doing. She's a Henry Crown Fellow at the Aspen Institute, where she is developing their Finance Leaders Fellows program. And so I know that's been something that's a real passion of hers. I want to welcome Ranji Nagaswami to speak.
Did you tell them we were classmates?
Yes.
Well, good afternoon. Thank you for staying. I know it's been a long day. There are three main parts to my talk this afternoon. First, I would like to review the role of finance in society. We all talk about it, but do we agree about what finance actually is and what it does? And with apologies, my lens will be on the US, because that is really where I've been able to get the best data. But I really want to also review the tremendous shifts in the components of finance and the industry's growth over the past 30 years. Second, as evidenced by surveys demonstrating the rather sobering lack of trust in the industry, I want to summarize and focus on two of the main tensions that I see between finance and the rest of society. And finally, I would like to outline one proposal that Will has already headlined, which has in my mind the potential to be impactful in the long term, to forge far deeper connections between finance and society, really by shining a light on the values of the leaders of the finance industries. As this audience knows, finance as an industry carries out four essential functions. First, finance tries and does, in fact, enable parties to pay each other. Second, it is how we mobilize society's savings. Third, channel these savings towards productive investments. And finally, and this is how we mostly think about finance, allocate financial risks to those most willing and able to bear them across economies and across the world. So finance has soared in importance. Global financial assets, or the value of equity market capitalization, stocks and bonds, corporate and government bonds, both traded and in a loan form, have grown from 12 trillion in 1980 to over 200 trillion in 2007. Now that's about 1.2 times global GDP to 3.5 times GDP. From the US perspective, that's over the same period, the US GDP rose 5-fold, and financial assets globally have risen 17-fold. In a recent paper in 2012, two professors from Harvard charted the robust growths and shifts in the components of the US finance industry's contribution to economic output over the last 30 plus years. And by the way, there was news in here for me, so I thought you would be interested too. Measured in terms of gross output, the financial services sector's share of US GDP growth, and these are all US numbers, grew from about 9.5% in 1980 to 15.6% just at the peak of the crisis in 2007. Now, if you look at it in net value added, those numbers grew from 1980 to 2007 from about 5% to about 8%. But the real story is in the components of that growth. In 1980, credit intermediation, which includes loan origination, credit card accounts, deposit accounts, and other banking services, accounted for 40% of finance's contribution to US GDP. Insurance accounted for 50%, or half, and market making in securities, including asset management, was a mere 10%. By 2007, interestingly, credit intermediation stayed at about 40%, 42% to be exact. But within credit intermediation, as Wilbur discussed this morning, banks lost share or stayed the same in terms of their overall share, but fees associated with the expansion and refinancing of residential mortgages soared. Now, this growth also reflected a very significant shift, as we all also know, in the machinery of the finance system, from deposit taking by regulated banks to the facilitation of borrowing by non-bank financial entities, which in turn was enabled by securitization, a part of the development of what we now call the shadow banking system. Over that time period, insurance's contribution fell. Remember, it was half. It now fell to about 25%, so it almost halved. And securities market share tripled to 30%, with half of that growth in securities markets coming from asset management. Asset management in 1980 was a rounding error in the same numbers. So clearly, a significant shift in the last 30 years in terms of the structure, the mechanics, and as I will demonstrate, the profitability sources within finance in the US. Now, when I saw the agenda a few days ago, looking at the whole agenda, and realized that Bob Shiller was going to start and talk about finance and society, and I was going to talk about finance and society, I thought I should just stay home. But fair to say that there are few whose aspirations for finance and what the industry can do for society I share more closely than Bob Shiller's. As Bob has pointed out, finance has played an important historical role as the engine that drives the good society. I have come to think of this connection between finance and society as the Shiller connection. If society is to function well for all its citizens, we need a strong and thriving Shiller connection. As Bob has aptly described, and I do recommend his book, innovations in finance, including pensions, savings accounts, mortgages, and insurance, among many others, a list to which he added amply this morning, have all aided human progress and helped to generate economic prosperity. Bob has also pointed out, however, that for this connection to work, all members of society must consider themselves part of the modern financial capitalism, and not, as too many unfortunately do today, the victims of the aggressive and selfish acts of a cynical financial establishment. As Bob alludes to, the outcomes for the rest of society from some of the industry's unsustainable growth leading up to the credit crisis have been far more negative than anyone imagined. What started as an unraveling of the residential mortgage bubble in the US brought the global economic systems to its knees, exposed widespread structural problems in many economies. Paolo is familiar with some of them, and introduce the concept of systemic risk firmly into our lexicon and financial models, sharply reminding us of the irreversibly interconnected and global nature of the finance industry and markets. Few industries, when you stop and really think about it, have the potential for its actions to be so devastating to the rest of society. It is no surprise then that these negative outcomes have resulted in acute public dissatisfaction, calls to fix the real problems with the system, and an erosion of societal trust in the finance industry. The Edelman Trust Barometer, a 27-country survey, annually asks the following questions about the main economic industries. How much do you trust businesses in each of these industries to do the right thing? Financial services and banks rank virtually at the bottom of all business industries surveyed, with only 54% of the informed respondents and 48%, much less, of the general public willing to trust financial services businesses. Now, I know you're interested. Only the media industry is less trusted. And a mere 30% of the respondents believe that the financial industry is actually interested in improving people's lives. Now, interestingly, and Teresa might agree with this distrust is not a global phenomenon. The financial services industry is trusted in about half the 27 countries surveyed. The geographic story essentially follows the failure of important financial institutions in the West. In the last 2 years, the lowest levels of trust were in the European Union, Ireland, Germany, and Spain, while the highest levels of trust were in Asia Pacific and Middle Eastern countries, India, China, the UAE, and Malaysia. When specifically questioned about trust in the finance industry's innovations, by a margin of almost 2-to-1, respondents categorized the industry as innovating too fast versus too slowly. When asked what they considered to be the biggest drivers propelling the industry's innovation, respondents saw technology, yes, we heard a lot about that, and business growth targets as the biggest drivers, followed next by greed and money. Improving people's lives, making the world a better place, limped in with the lowest perceptions on what drives the finance industry's innovation. Does trust matter? A rhetorical question, of course, because it is a problem for our industry whose mission it is to be the engine that drives the good society when 1 out of 2 people in that society distrust our business practices, when greed and money are seen as one of the primary and interest in improving lives as the least of the drivers of our innovation. Finance, to many in the rest of society, is an industry incapable of self-regulation or of averting negative societal outcomes because of its worst business practices and self-serving behaviors. There are deeper worries than the episodic potential for severe losses. In coining the term financialization, Gerald Epstein condenses the growing worries about the vastly expanded role of all the members of the previous panels: financial motives, financial markets, financial actors, and financial institutions in the operation of domestic and international economies. Some have gone so far as to question the very value of a market society itself. Michael Sandel poignantly laments the price we pay for living in a society where everything is up for sale. Will financial capitalism lead to a different form of social contract if the plutocrats are setting the goals of society rather than the goals of society being derived by a consensus within society? And if we are living in an era of financial capitalism, how do we ensure that we are going to go in the right direction for all? Let me consider 2 of the main tensions between finance and society that make these questions particularly pertinent. First, impact of the industry's recent innovations on society, and second, implications of the surge in the industry's profitability on income inequality. I propose to consider the impact of innovation in the context of the industry's recent growth. Some of the answers on whether financial innovation has helped or hurt society depends in large part on how one considers the social benefits of its main growth areas, active asset management, and the household credit financing industry, including shadow banking institutions. While admittedly these have grown faster in the US than in other places, I do think some of this is relevant globally. Few will argue against efforts by the asset management industry to enhance and make savings more productive and ultimately increase the spending power for society's savers. To do this, we need both an increase in financial market participation as well as the prudent management of these assets through diversification. Better returns on their hard-earned savings vastly improves the chances of ordinary citizens and average workers not running out of money in retirement, even as we live longer, of parents fulfilling their children's dreams of a college education, and of households compounding their savings to buy homes, all significant societal goods. The percentage of households owning stock increased from 30+% in 1989 to just over 50% in 2007. A bit over half of all household equity holdings are now professionally managed, compared to 25% in 1980. In addition to the list that Bob would talk about, the asset management industry's innovations like passive funds and ETFs, solutions-driven services such as liability-driven investing, asset allocation funds, risk parity, the increasingly global nature of many equity and fixed income mandates have all improved or have variously improved diversification of investments, reduced fees, the passive, of course, only, and strengthen alignment between principals and agents, between client needs and asset management industry innovation. And as Bob discussed, and behavioral economists have irrevocably demonstrated, the strongest benefits of some of these innovations are those that incorporate features like auto-enrollment, auto-escalations, and preset asset allocations, which have really proven to remove the pernicious impact of worst human tendencies by increasing participation and improving the chances for better outcomes. So what are the tensions if asset management is doing so well? There are many. They relate primarily, though, to its high costs and failure to meet alpha expectations or mitigate risks as promised. Given the increase in institutional assets in private equity and hedge funds, I will focus on those asset classes in particular. Much criticism has been targeted at the asset managers in these sectors for failing expectations. A meaningful number of private equity managers have underperformed equity benchmarks once you adjust benchmarks for additional leverage taken on by these funds and reduce fees. Many hedge fund managers have demonstrated acute market beta sensitivity, utterly failing to hedge, and predictably generated far less alpha than promised. Asset management does need to stop as an industry and have a more honest conversation about whether it is setting expectations properly and not overselling its return-generating and risk management abilities. Since by definition, the alpha-seeking industry remains a zero-sum effort in aggregate, is there still too much high-cost active asset management? From a societal perspective, the level of rents in this industry becomes even more important as we age and become more reliant on our savings to carry us through our longer retirements. Basis points simply begin to matter a lot more. There is an additional implication of the way finance is used by some investors that deserves consideration. Unlike the innocent and unschooled in economics, who undoubtedly need to be protected, informed professionals and fiduciaries can become quite complicit in perpetuating failures attributed to finance. Investments made by these actors can be driven by unrealistic assumptions about economic relationships, assumptions that are incomprehensible to the economists themselves. These actors are equally part of the problem if they attempt to implement well-considered financial theories and enter asset classes despite known cultural and organizational constraints, then blame the theory for their foreseeable failures. These investors too, the users of these investment services, need to stop and consider their own organizational culture, decision-making processes, and implementation realities, something I acutely witnessed myself, as Will pointed out, when I helped with the City of New York's pension funds, before investing in complex or illiquid investments that are not suitable for everyone. And David Swenson did not pay me to say that. Let me turn briefly to the impacts of innovation within credit intermediation. The goals of innovation in this sector, led by the non-banking financial entities, the so-called shadow banks, was indeed laudable: to provide greater liquidity, improve access to credit, and share risk across the financial system. And yet, as Brookings fellow Robert Latan has observed, some innovations, CDOs, SIVs, were poorly designed. Others, credit default swaps, ARMs, were misused. These contributed to the financial crisis and amplified the downturn in the economy once it started. Many academics, including our own Gary Gorton and Andrew Metrick, have also noted that while shadow banking certainly made household credit both cheaper and more available, shadow banking likely decreased financial stability. These innovative excesses clearly reflect poor risk management within firms and need to be curbed. New innovations must be tested within firms for their potential outcomes on society well before they are launched. This is imperative because future innovations, particularly those centered on online and mobile technology, as Wilbur amply demonstrated this morning, have the capacity to revolutionize how we interact with financial matters. I think he called it smart banking, but financial tools, including free credit report monitoring, online banking, bill paying, trading, wealth management, have tremendous potential to simplify and integrate financial decisions more easily into our daily lives while cutting costs. To many in society, though, the innovations offered not just by the mortgage companies in the mid-2000s, but even today by bankers, financial advisors, credit providers, and asset managers are unduly complex and opaque, and as the cynics would see it, designed to generate additional profits for the industry. Finance to these credits seems far removed from its primary function of dampening risk and is instead seen as creating risk. My own conception is a more balanced assessment. Phew. I agree with the ultimate verdict, however, that there is a mix between good and bad financial innovations, although on balance, I find more good ones than bad ones. Let me turn to tensions around income inequality and potential distortions in talent. Even as the composition of the financial services sector has shifted, the profitability of the industry has soared. 30 years ago, the financial sector claimed around 1/10 of US corporate profits. By 2012, it was almost 30% and has ranged between 20 and 40% since 2000. This increase in profits has been beneficial for the industry's workers while generating enormous wealth for its top echelon. In 1980, the typical financial services employee earned about the same wages as his counterpart or her counterpart in other industries. By 2006, employees in financial services earned an average of 70% more. Recent academic work has shown that income gains have been spectacularly impressive for those in the highest echelons of finance. The percentage of those working in finance in the top 1% of income virtually doubled between 1979 and 2005 to 14%. Among taxpayers in the top 0.1% of the distribution of income, the share of financial professionals increases even more dramatically from 11 to 18%. Generous pay packages for Wall Street jobs in particular have proven irresistibly alluring, and the industry has attracted a disproportionate share of managerial talent. In 2014, 33% of Harvard's MBA class took jobs in financial services upon graduation. At its peak, that number was 45%, compared to a mere 9% in 1980. As a society, it is important to stop and ask what drives this attraction towards finance. And I'm very sorry Paolo had to go, because I agree with him. As someone who formed part of this statistic for Yale SOM, as did my husband, nearly 30 years ago, let me contend that the very process of pursuing excess returns in one part of the finance industry I know a little bit about, asset management, holds significant socially valuable information. Continually improving the process of learning about companies, industries, economies, and markets, price discovery enabled by trading, equity and bond analyst scrutiny and questioning of business managers and strategies, business formation driven by venture capital, private equity's provision of capital and expertise to companies for needed growth, ease and speed of capital mobility driven by payment system, all improve the efficiency of our societies. Equally, these pursuits in themselves are highly intellectually stimulating, not merely financially lucrative. It is this powerful combination that draws many of our brightest MBAs to this industry. And yet, some might rightly argue that the industry's talent pool relative to its share of economic output is a societally troubling trend, for it represents potentially a real distortion in the allocation of talent across all possible productive uses in the economy. Does it make societal sense to have some who work in finance reap such a greater level of reward for their work, while many working in other industries earn far less? Is it a surprise that tensions around high compensation levels in finance are soaring if those working in other sectors of the economy and the middle class and the poor within society as a whole see themselves losing ground? What is particularly galling to many in this regard are the government bailouts, seen by them as society stepping in to assist a few well-heeled and tin-eared bankers and financiers who created the systemic crisis in the first place. As successful participants in a capitalist economic system, leaders in finance, or any other industry for that matter, in my mind, need not be defensive about increasing their incomes, so long as their work positively contributes to society through their products, business practices, and culture. Admittedly, it isn't entirely clear just how directly the wealth and income increase for a few correspond with their productive contribution to overall economic output that helps the rest of society. The contrary view, posed by none other than Fed Governor Paul Volcker, among others, is that the finance leaders and CEOs have merely been the beneficiaries of strong economies and equity markets that have driven up the economic value of their stock options. The beneficiaries of this certainly can't take all the credit for it personally. Many of these beneficiaries have indeed become active in society by giving back through philanthropy in a range of human endeavors. A poignant question about this way that modern-day plutocrats respond to their increased wealth was recently raised at an Aspen Institute gathering and deserves our consideration. In a provocative speech, New York Times columnist and Aspen Henry Crown Fellow Anand Giridharadas challenged the notion popular among the intellectual and financial elite in society that it is okay for a few to get rich so long as the same few give back to the rest of society through their philanthropic acts. Anand pushed back strongly against this willingness to accept some excesses as an inevitable byproduct of capitalism as long as there was this giving back. His challenge: instead of getting rich and then giving back, the elite need, and I quote, to do less harm in the first place. The debate that Anand has sparked in my mind centers on how the rich in any endeavor get that way. What innovations are sparked and business practices perpetuated that lead to such spectacular fortunes, even as society bears the painful burden of the negative outcomes of some of these practices? And if fortunes are going to be made through financial innovations, then Anand's message to me is that the industry's leaders need to fix and improve the innovations and the system itself. And we must be willing to balance personal gain with better social outcomes, to lead a more values-based business, even at the cost of a less lucrative personal fortune. Just how we do this is a debate that I hope this audience will join, for it is in all our interests, I hope you agree, as we consider the future of finance, to align the incentives of our most successful leaders and colleagues with the rest of society. Unsurprisingly, these tensions have led to calls for more regulation, constraint on the industry's compensation policies, and vastly stepped up monitoring of its business practices and innovations. I do share some of Wilbur's worry that too skeptical a view by policymakers of innovation and a desire to erect steep regulatory barriers to vet new products will hurt society, not just unduly slow innovation. The heightened level of oversight may end up overestimating what well-meaning regulators with very limited resources can reasonably achieve relative to a vastly better resourced industry whose innovations come with speed and complexity. But above all, I fear that even at their most effective, these measures are in themselves insufficient in the long term to tackle the root cause of the issues that need addressing in the finance industry today. This leads to the final aim of my remarks today. I would like to share one proposal to connect the industry back to Bob Shiller's rightful conception of its enabling role in society. As Will mentioned, I'm part of the Aspen Institute's Global Leadership Network, and I have been working with the Institute and many others to launch the Aspen Finance Leaders Fellowship, a fellowship program that seeks to develop responsible, community-spirited leaders in the global services industry. Our motto, to move these leaders from success to significance. Using the Aspen method of text-based Socratic dialogue and building upon its commitment to values-based, action-oriented leadership, the program aims to spur selected finance fellows to consider values and perspectives necessary for effective, enlightened leadership in finance and in society at large. Why, of the many ways I could have humbly attempted to make my small dent in restoring the Schiller connection, have I chosen a fellowship of leaders? Let me share some beliefs that drove me to this proposal. Foremost is my belief that leaders shape history, society, industries, and companies. Not surprising, perhaps, as I stand here at my beloved alma mater, Yale School of Management, whose explicit purpose is to train leaders to lead business and society. It is the unique individual that shapes and leads change, identifying society's intractable problems and inspiring others with purpose and a strategy to implement social change. Leaders from across the financial ecosystem who see the restoration of the Schiller connection as a moral and society imperative represent, in my mind, the single best chance to achieve Schiller's ideal. Who are these leaders? They are senior thinkers, doers, and organization builders of the finance industry's global ecosystem. Among others, they are bankers, asset managers, credit financiers, regulators and central bankers, audit partners, fintech disruptors, and impact investors, CFOs, and pension fund CIOs. Said differently, they are the savers, users, intermediaries, and stewards of capital. But far more importantly, what are they like? Like their most preeminent forerunners in the industry, visionaries like John Whitehead, Paul Volcker, John Bogle, global leaders like Mohammed Yunus, Yale's very own Bill Donaldson, Charlie Ellis, and David Swenson. These are leaders who fundamentally believe in the societal value of finance. They are courageous enough to step into the arena. thoughtful enough to want to deeply consider their values and highest purpose, entrepreneurial and driven enough to execute on their commitment, and successful enough to be role models to the rest of the industry. We don't need thousands of them. We need tens, maybe hundreds. These are singular leaders in the finance industry who find themselves at an inflection point in their successful careers and want to do more for society with this success. I have also come to believe the importance of having these leaders pause and reflect on their values. It was fantastic for me to see a slide this morning that described what the good society looks like. When else, how few places would you see a slide like that? Yet it is through a profound process of pure dialogue and personal reflection that will come the possibility of a transformational awareness of values, beliefs, and ideas about the good society to spur these leaders in finance to purposeful action. Socratic dialogue among a peer group of fellows selected for each fellowship class will be centered on a carefully curated selection of timeless readings that date back to Aristotle and Plato, Locke and Hobbes, Gandhi and Martin Luther King. Readings that reflect profoundly on human nature, on the sometimes conflicting and balancing roles leaders play in deciding between socially polarized outcomes of liberty and equality, efficiency and community in this good society, on the central role of finance in such a society. The third belief driving the creation of the Finance Fellows Leadership Program is the impact of fellowship for action. Leaders are most likely to act if surrounded by a peer group of equally successful thought partners who are shaped by diverse views yet share similar values about their leadership role in society. Two of my fellows who provide this fellowship, other than my husband who is here today, are Ellen and Will. And it is this fellowship that I feel in a joint mission that spurred me in my life to action. In 2005, nearly 20 years after graduating from SOM, I was nominated by then SOM Dean Jeff Garten to this Aspen Fellowship, to the Henry Crown Fellowship. My invitation, as it turned out, to hit the pause button and reflect on my leadership values and my responsibilities for impacting society at large. The fellowship served as a transformative wake-up call. For the first time in my life and career, I pondered the values I hold as a leader beyond the labels society assigns a select group of people who have demonstrated success based on their skills, their abilities, and their achievements. I considered how my values and actions had been shaped by my views of human nature, whether my career choices hewed to my highest and best Aristotelian purpose. I pondered the imperative of heeding Martin Luther King's call not to be a bystander and the beneficiaries of others' work in shaping the society we live in, but as an active participant. I realized my deepest aspiration was to be a servant leader like Gandhi, even as I wondered if I was capable of his heroism. I debated whether my true leadership test was to achieve greater career success or greater balance between my individual ambitions and societal challenges, between the spirit and the mind. A balance, as Edith Hamilton describes, of a mind that must see a thing never in and for itself, but always connected with what is greater. To be sure, this Finance Leaders Fellowship proposal requires a long time horizon and will be hard. But it is in a group of leaders joined in their fundamental values about the connection between finance and society that I place the greatest confidence for the future of finance. Let me conclude. I am certain that I will not have gone far enough in my constructive critiques of values and tensions between finance and society for some this afternoon, and I will have gone way too far for others. I am a firm believer that finance at its core lives up to Schiller's ideal of being the engine that drives the good society. I also agree with Bob Schiller in saying that rather than condemning finance, we need to reclaim it for the common good. That the industry's innovation is a messy and disruptive process, but we must encourage it. I believe that human nature is inherently good, and in enabling human progress, finance appeals to what is best in each of us. Yet, human foibles that can divert us to self-serving and even destructive tendencies are very real and need to be managed and understood. I am convinced that with more enlightened leadership, the finance industry can restore its connection with society and design its products and business models to explicitly consider human foibles. Equally, without the right leadership, restoring the Schillerian connection may prove elusive. I am confident that with time, support, and tenacity, the audacious goals we have set for the Finance Leaders Fellowship have a chance of being achieved. Thank you. Questions?
Is this on? Okay. My question is, do you think that taxation is the answer for the perceived or actual inequality that has been the bane of our society? And in addition, and specifically, the carried interest, shouldn't that be taxed as ordinary income instead of taxed, as it has been for decades, at capital gains rates? Isn't that an abomination and a glaring inequality in our system?
It is glaring. And I would agree that to some measure, I don't know how much, that tax difference has contributed to the wealth in some parts of the finance industry. Would I call it an abomination? I think yes.
Hello, Adrian Dalman, City Compliance, and Yale class of '99, actually. You made a lot of comments about sort of availing yourselves of more enlightened leadership as a way to address some of the not only image but true value problems we have in the financial services industry. And that's, I mean, certainly laudable and whatnot, but when you look at the problems we've faced that lead to this massive distrust and whatnot, a lot of these problems are perhaps less lofty in their origin and definitely more operational in their application. I mean, if you look at the FX traders who manipulate markets, if you look at the robo-signing that somehow got past compliance officers or compliance officers who did nothing about it, if you look at the bankers who strip Iranian or Cuban information off of a wire that allows the money to pass through the system without the proper checks and balances taking place, these aren't really problems that avail themselves of a long time horizon to which you spoke, and I wondered if you have any thoughts about steps that could be taken with a more immediate operational impact that could actually move that needle in a short-term basis as opposed to a longer time horizon.
So the short-term fix is jail or regulation. I don't know anything else. And the problem with that is that when those pressures ebb or when that becomes less likely, behaviors don't change. The point I'm trying to make is if we want to change the culture of an industry, that takes a really long time. So I don't have a short-term fix for you. I think what we're trying is it. We will try, it will work, it may not work. When you go back to the robo-signing as one example, and you had many, but let's pick one, how much of that came from a culture that had quotas for what the salespeople had to meet to go, or the loan officers had to meet? How much of that was supervisors not caring about the volume as long as they met certain business goals? That culture is set at the top. Those things filter down very clearly in an organization. So yes, I completely accept. My proposal is a true long-term proposal. I worry, though, that much else is Band-Aid, and that unless we change the culture and the way businesses function, we're actually simply solving one short-term problem but making the next one likely. When I particularly consider the level of attention towards compliance, where compliance has become something that banks are required to do and are not embracing because they think it's the right thing, I worry yet again that it is a check the box rather than a fundamental shift in how businesses in this industry operate. So to me, there are many who will be working on the short-term problems. I had to pick my spot, and I picked the long-term solution, what I see as the long-term solution. Question in the back here?
David Tetton, Yale undergrad. So I looked at the website for the Finance Fellows program. What was interesting is it talks about the good society, and it feels like you have the same design challenge that a lot of the top business schools had post-2008, which is a lot of business schools said, we want to teach our students ethics and morals, and we want them to do the right thing. We don't want them to be an embarrassment like Enron and so on. But how do you define that? What are the KPIs for a good society? How do you measure that? How do you define that? So I'm curious if you can give a little more definition as to the set of values that you're trying to encourage people to either have or bring out, because that's something that I have not heard a good answer from any of the top business schools who have also wrestled with this problem.
We may need alcohol for the full answer. But to be brief, the first and most important thing in my mind in answering your question is, as a leader, when you are trying to decide the role of your company or your leadership in society, the first thing you need to understand about yourself is, what do you believe about human nature? Do you believe that we are inherently good or inherently evil? If you think we are inherently good, you will design systems and processes that have a high level of trust between you and those in your company and under your care. If you think you're inherently evil, you're going to have checks and balances all over the place because you think people are prone to doing things that are inherently bad. As a stockholder, if you think a company is inherently good or inherently evil, you will treat it in similar fashion. So what you believe about human nature informs leadership styles. Now, I think we do walk around basically to the nice comment, the notion of good society being nice people doing nice things to one another, not bad things to one another, I think is the central concept. But when you think about societies with tremendous punishment for crimes, you start to see that there is maybe another side where there is another belief. So how do you view human nature, and how do you conduct your business and your business practices in society have a lot to do around that. The second big issue around the good society to me are, if you pick up a book, Jim, I'm forgetting his last name, but the Executive's Compass. And it describes essentially the trade-offs that we make every single day in society, but particularly as leaders. And those are, if you think of a compass, north, south, east, west, liberty and equality. If you want more equality, then you have to take from someone and give to someone else. But the person you're taking from has as many rights as the person you are giving to. How do you make that trade-off? So the goal of thinking about the good society is not to come to one answer for everybody. That would be an utter failure. It is to think about trade-offs like the one I talked about. Another, across East-West, you might have community, liberty and equality, efficiency, and community. And we talk a lot about improving efficiency in finance. Well, how do you balance that with the need of the community, of society? So the good society is one that figures out the balance between what seems like really polar tendencies and polar claims on good, on what happiness or wealth or any of those might construe. More later. Microphone here. Actually, how about right behind you to start, and then I'll come back to you. And, great.
I'm Matthew Bloomberg. I'm a first-year MBA student. I'm just wondering, do you think the different sects of the finance industry, do you think that they're culturally independent, or do you think that by changing one sect will have a domino effect, or changing the culture of one sect will have a domino effect through the other sects?
Well, history has shown that, in fact, they're very correlated. If you think about the financial crisis, I would argue that the regulators were complicit. So, you know, you can think about it as, if I think about users and savers of capital, I sometimes think that the savers are complicit because we want high returns with no risk. So I think there is an interconnectedness, perhaps, and I think that there are cultural swings, right? So when we were in this great swing of deregulation, the regulators were lax, industry then pushed the limit, if you would, and I think it's that complicit nature of that relationship that became part of the problem. So I don't know if I'm answering your question, but, and then if I think about asset management versus banking, I actually think, I'd like to think that finance is extraordinarily diverse. And certainly the way people use finance seems similar in terms of credit or savings investments. But when you think about impact investing today versus what CalPERS does, they are both investing. They are both looking for economic return. Maybe one is looking for other elements of return. But they're both operating on fundamentally the same economic theory. So I think economic theory cuts through all of finance. There was a question right there.
Hi, Ranji. Michael Simonetti from Harvard. You know, the plan you've outlined and the ideas you're expositing are ones around creating better people. In other words, you can't build processes because smart people will be able to get around them. You're going to create better people in leadership positions, people with real moral frameworks. And the question I have is there a particular reason to do this in finance versus anywhere else? I could pick out any person in any government or in almost any industry who've made horrible, sort of deeply immoral choices, and you can regulate around them. You can look at car companies or, you know, government guidance or whatever. Is there something unique? Is there a unique opportunity among financial professionals that this type of program makes sense? Is it more needed? Do you view it as more needed? And I'll stop there.
The program exists for other industries and geographies. You can go to the Aspen Global Leadership Network website and have a look. The reason for finance, though, was my real fear that we needed to do something long-term to really think about this frayed Schiller connection. So for me, this was really about the industry that I love, that has given a lot to me. And this notion of give back versus do less harm is something that keeps me up at night. And the only way you manage that trade-off is by fundamentally rethinking your value system. So that's why, and this ability also of finance to bring the world to its knees. How many industries can do that? So I felt a particular need in finance. The Aspen board agreed, but this program exists in many other places, mostly geographic.
Hi, my name's Jason Kopolis. I'm a second year here at SOM. You spoke at the beginning about realigning the expectations and realities, especially of returns in finance. There was an article, I think it was last week in the Wall Street Journal, about a lot of pension funds are revising downwards their long-term guidance for returns. And I wondered if you thought that that is responding to people's changes in attitudes, or is instead trying to lead them? Is that a cart or a horse?
Oh my. That article was about something called the actuarial investment return, which is an assumption that public funds across the United States use to discount their pension liabilities. And it simply is, in the way this works, their estimate on what the pension plan can earn. And generally, it's over a 5 to 10 year period. That number in 2010 averaged 8% across the US. There isn't any economist I knew that looked at a 60-40 portfolio of stocks and bonds and thought that it could earn 10% over a 5, 10, 20 year period. Think about it very, very simply. If equity risk premia are generally somewhere between 4 and 5% over risk-free yields, how are you going to get to 8%? Or said another way, what is the level of risk you're going to have to take to get to that 8%? So the article you saw said that on average, that 8% number has now come down to a whopping 760. When I was in New York City, I advocated for that number to be 6%. And I said that too was likely too high. So I think these numbers are still a bit of chimera, still a bit of high discount rates make present value of your liabilities lower. And therefore, these are funding problems that are very real. And these are real trade-offs in society, particularly with the public pension system. So I think it is very much the cart, very much following, but with a 10-year lag. Thank you all very much.